Many of you have come to know me as the angry mentor, and while that's not necessarily what I set out to project, as I matured as a trader, I began to take issue with a lot of the well-meaning advice that we receive as traders because I noticed that upon even a little bit of extra scrutiny, they fell apart. Let me give you an example of something I've always been fighting. This idea, one model, one setup for life, one session, one pattern, that's what you need to make a profit. Like, what kind of stupidity is that? How is that what you're peddling? So tell me, we didn't know anything about trading. You came to the markets. Did you come to learn how the market moves and operates? Or did you come to learn your model that you're going to impose on the market and only trade that? It's like a doctor saying, I only treat malaria. I'm a malaria doctor. I'm excellent at it. I know all the symptoms. I know all the medication to prescribe. So if you have typhoid, don't come to me. How does that make sense? Just to demonstrate this, I'm going to show you some of the different types of entry models that you can use to get into trades on your own. Now, note traders, this is entry patterns. There are so many levels I've skipped. Doing your bias, doing your analysis, framing your points of interest, getting your market structure. This is only for entries because I'll tell you this one now. You go into your charts tomorrow, and once you see it on the 2 minutes time frame, that's what you start using. Please don't use my content like that. One of the ways to enter is the liquidity sweep. Price creates a high, preferably there's a higher time frame imbalance over here. Price comes, takes it out, and when you see this is your entry. You put your stop loss here, and then you can target something down here. But this is the important thing. You must see this close back inside the range on the time frame when you're seeing this high. So if this is happening on the 4-hour time frame, there's a 4-hour high here, and maybe this can be a daily fair value gap. If a 4-hour candle does not close back inside here, this is not a confirmed liquidity sweep of this 4-hour high because this is 4-hour liquidity. So you shouldn't be using a 15-minute close back inside the range as an entry for this type of model. If you want to use the 15 minutes, what you're looking for is a change of character on the lower time frame, which brings me to the next entry model. Sometimes there won't be a liquidity sweep. Maybe the 4-hour time frame has swept liquidity somewhere here, and then it has started moving down. There's a fair value gap here. Now, when price comes back into that fair value gap, you can use the 15 minutes to look for a change of character. So the 15 minutes on its way here would look something like this. On the 15 minutes, what you're looking for is this. So it's not necessarily a liquidity sweep of any liquidity to the left. This might not even take out this high. It might just do something like this, create a lower high. But as soon as you see that change of market character, a higher low has been taken out, and then 15 minutes closes beyond that higher low, then you have confirmation that this 4-hour point of interest maybe wants to hold, and then you can take your entry here, put your target here, and put your stop loss somewhere here. Another way you can enter, this is one of my favorite ones because I discovered it myself as people don't like to talk about it, is a consolidation breakout. This is one of the most powerful. Listen, if you have a fair value gap here, another fair value gap here, you have liquidity here. If the market drops and you start seeing this, don't be surprised if price does not come back into any of those points of interest created above. The reason is that consolidations form a base in price. They become the new fair value in the market. So ideally, you want to see a sweep of the consolidation high. But if you don't see a consolidation high sweep and you just see a breakdown below, as soon as you see